On the evidence of broad indices, markets were reasonably calm in the third quarter. However, there was a wide divergence of returns underlying that, and some developments to worry investors. Global equities gained 5%, but as has been the case throughout 2018 so far, these headline index gains were very narrowly driven by the exceptional performance of high growth stocks in the US, most notably the so-called FANGs, Facebook, Amazon, Netflix and Google, and more broadly IT-related stocks. These sorts of high growth stocks have been outperforming for several years, and the lead over the rest of the market is now on a scale not seen since the tech bubble nearly 20 years ago. While they drove the vast majority of the US market returns, and indeed global equity returns, most other markets delivered weaker gains, or in many cases losses. Meanwhile, more defensive asset classes also performed poorly, including listed real estate, government bonds and gold. The majority of the Harmony funds were either flat or down over the third quarter of 2018, with only the US Dollar Growth Fund posting a modest gain of 0.5%. The worst performing fund was the Asian Growth Fund, down 1.5% in US dollar terms. These two outcomes reflect the divergence in equity returns across the home regions for these funds. All of the funds benefited from their allocations to high growth equities to some extent. For example, in the US dollar portfolios, the Granahan holding was up over 16%, but our exposure was insufficient to offset weaker performance elsewhere. The well-diversified nature of the Harmony portfolios across geographies, asset classes, currencies and investment styles has proved a headwind to performance in this environment, particularly when compared to US or global equity index returns. But building resilient portfolios with a wide variety of underlying return drivers remains the best way forward in order to withstand the inevitable bumps on the way through this extraordinary cycle. Indeed, so far in early October, equity markets are experiencing a significant pullback, but the Harmony funds are holding up relatively well through this. Longer-term performance for most of the funds remains in line with or ahead of our absolute return objectives on a net of fees basis, while performance is also highly competitive versus peers, particularly when considered in risk-adjusted terms. Our long-term, outcome-oriented investment approach means we are generally able to cushion portfolio losses during weaker periods in markets, and then take advantage of opportunities that market volatility presents. For example, during the last quarter, we increased exposure to dollar-denominated emerging market bonds across all of the funds, an area that has performed poorly so far this year, leading to yields rising across the board. We've taken this position with a long-term investment horizon in mind, but they've already paid off well in the short term since our adjustment, gaining 2% in September alone. We also added a new strategy within this area to diversify our risk via the Jupiter Emerging Markets Bond Fund managed by Alejandro Arevalo. Having interviewed and analysed many managers in this area over the years, our investment team is confident that this is one of the best and most capable emerging market bond teams globally. Although the global economy generally remains in good shape, with reasonable growth combined with subdued inflation, this is not a time for investor complacency, as there are several reasons to expect a period of bumpiness in markets ahead. It's becoming increasingly likely that the trade war between the US and China will persist for some time, and could have a rising impact on confidence and growth. But most importantly, the US Federal Reserve will continue to tighten policy by increasing interest rates, probably to over 3% by the end of 2019, whilst also removing liquidity. This will cause bond yields to rise further, which puts pressure on other asset values and, although unlikely, any unexpected increase in inflation from here could increase the impact this has on markets. We've taken steps over the last year to build greater resilience into portfolios. In particular, we've built up some exposure to US Treasuries, focusing on shorter maturity bonds, which are less interest rate sensitive, but which still offer reasonable real yields over and above inflation. This has largely been funded by reducing holdings in corporate bonds, in those areas where we no longer feel we're being adequately compensated for the additional risks involved. Meanwhile, we believe most equity markets are offering good prospective returns from current valuation levels, so that remains the core exposure across all of the funds, although we're increasingly cautious about the high growth stocks that have outstripped the market so much in previous years, where valuations are relatively high. We believe it's appropriate to stay invested through periods of volatility, and for our part, we will use the inevitable setbacks as opportunities to add to positions selectively, which will lay the foundations for continuing to deliver on our longer term return objectives.